We talked about consolidation in the year of acquisition if the parent has been using the equity method, or if the parent has been using the initial value method. Now let's look at what if the parent is using the partial equity method. So first, let's look at what is the difference on the parent book if the parent is using the partial equity method. So first of all, if you still remember, the only difference between partial equity and the equity method is for partial equity method, we don't need to worry about intra-entity transactions, and we don't need to do amortization of excess payment. So basically, adjustments are recorded in the investment account for the current year income and dividend paid by the subsidiary, and no adjustment for amortization of purchase price allocation, which is just the excess payment during the acquisition. And then here, we're going to talk about intra-entity transaction later, but here it didn't mention intra-entity transaction, but intra-entity transaction is not something we need to worry about for the partial equity method. Although for the equity method, we need to take that into account. And then difference on the consolidation worksheet. So basically on the consolidation worksheet, almost everything's exactly the same as what we did under the equity method. The only difference is for consolidation entry I, the journal entry is still the same. It's just we use a different amount. So we eliminate parents' equity in subsidiary earnings, but for a different amount than that is under the equity method. So which is basically in that amount, we don't need to take out amortization. And if there's any intra-entity transaction, we don't need to take that out neither. So let's continue the previous example. Now the parent used partial equity method, and then it is the year of the acquisition. Let's look at how to do the consolidation worksheet. So if you go to the worksheet, please look at page 3 of your worksheet. So again, it is the year of acquisition, and the parent is using the partial equity method. So let's first again look at the first column of this worksheet. So this column is taken from what you did from our last class. And let's go over the equity in subsidiary earnings here again. So this number 100,000, that is the subsidiary's current year income. And we don't need to take out amortization here. For the investment account, so this 860,000, that is made up of your initial investment 800,000 plus the first year's income minus the first year's dividend, and that will give you 860,000. Okay, so let's look at consolidation entry S. We use S to eliminate subsidiaries shareholders equity account. So we debit 200,000 common stock, 20,000 additional paid-in capital, and 380,000 beginning retained earning. And accordingly, we decrease our investment account by 600,000. For consolidation entry A, we mark up subsidiaries book value to fair value and recognize any goodwill if there's any. Specifically for trademark, we have 20,000 difference. Patented technology, 130,000 difference. Equipment account, negative 30,000. Goodwill, we have 80,000. And then so investment account goes down by 200,000 accordingly. Consolidation entry I, we use it to eliminate the income recognized by the parent, subsidiaries income recognized by the parent. So equity in subsidiary earnings is 100,000. To eliminate it, we debit 100,000. And then we decrease the investment account by 100,000. Consolidation entry D, we use it to eliminate the intra-entity dividend payment. So specifically, we debit dividend declared by 40,000. We credit dividend declared and debit the investment account by 40,000. Consolidation entry E is the same as before. Specifically, we recognize depreciation amortization expense 13,000. And this is associated with the patented technology. We also recognize depreciation expense. So this will decrease our depreciation expense by 6,000. And this is associated by our equipment. So the last step to figure out consolidated total, we add up most of the rows horizontally. But for some rows, we need to do it vertically because we didn't. So because all of the consolidation entries impact the specific account, and for those, for example, net income, this is a sum up number. We didn't. So none of the consolidation entry directly is recorded to net income account. That's why when we do the consolidated totals for net income, we need to add it up vertically. For revenue, we're getting 1,900,000. Cost of goods sold is 932,000. Amortization expense 165,000. Depreciation expense 110,000. Equity in subsidiary earnings is 0. Dividend income is 0. And then if you add everything up, that will give you 693,000 net income. And then your net income is carried over to your statement of income. Your retained earning, if you add up everything, that will give you 840,000. Dividend declared will give you 120,000. If you add up everything, that will give you ending retained earning of 1,413,000. And you carry over this to your balance sheet. On your balance sheet, your current asset is and then if you add up everything, that will give you your total assets 3,561,000. Your liabilities will add up to 1,428,000. Common stock 600,000. Additional paid-in capital 120,000. And your total liability and shareholders' equity will add up to 3,561,000. So, and then we just do our normal checks. So the first thing you check is your equity and subsidiary earnings should go to 0. Your investment account should be 0. And your total assets should be equal to your total liabilities and shareholders' equities. So there's one last thing I want to kind of mention. So similar to the previous ones, let's first look at the equity and subsidiary earnings. So this account, it is eliminated totally by consolidation entry I in the consolidation process. And your investment account, so this 800,000 again, it is made up of your net book value plus the difference between fair and book value at the date of acquisition plus goodwill. So your net book value is eliminated by consolidation entry S. The difference between fair and book value plus goodwill is eliminated by consolidation entry A. This 100,000, so your current year income is current year subsidiaries income recognized by the parent is eliminated by consolidation entry I. And this 40,000 dividend is eliminated by consolidation entry D. So that's why after the consolidation process, your investment account will go to 0. So, and then, so here, consolidation entry I, the entry is the same, but the amount is different compared with the equity method.